ค่ะสวัสดีค่ะทุกท่านยินดีต้อนรับเข้าสู่การนำเสนอข้อมูลของบริษัทพีเชียชิปปิ้งจำกัดมหาชนสำหรับไตรมาส 3 ปี 2022 นี้โดยคุณคาลิด ฮาชิมกรรมการผู้จัดการทางด้านขวามือของดิฉันจะนำเสนอข้อมูลในเรื่องของอุตสาหกรรมนะคะแล้วก็ต่อไปก็จะเป็นในเรื่องของคุณก่อตั้มปูรานาจะนำเสนอข้อมูลในเรื่องของตัวเลขผลการดำเนินงานที่ผ่านมาและในส่วนสุดท้ายในเรื่องของคำถามคำตอบซึ่งก็สามารถที่จะคีย์คำถามคำตอบเข้ามาในระบบได้เลยนะคะค่ะเชิญคุณคาลิด ฮาชิมค่ะ
สวัสดีครับ As usual, we will do this presentation in two parts. In the first part, we are going to talk about the industry structure. So here you can see clearly that the rates have gone up and then they've come down, and now again they're starting the climb back up again. If you look at the 9 months of Chinese activity, it was really down compared to last year's 9 months. Iron ore was down by 2.4%. China's coal was down by, imports were down by 12.9%. Steel production was down by 3%. The steel imports were down by 23%. Steel exports were down by 3%, and steel consumption was down by 3%. Therefore, China really underperformed. And since China is one of the largest supporters of the dry bulk market, the fact that they underperformed and yet our first 9 months results are much better than the last 11-year average, it means that China's impact was felt, but not as severely as markets had expected. Now, if you look at the growth in seaborne trade, you can see the growth rates over here, and you can see quite clearly that the growth rate in 2022 is predicted by Clarksons at just 0.55%. Against that, Clarksons are predicting a growth in tonnage of 3.42%. So with this type of a situation, we should have had a fall in the market, but we did not. As I said, the first 9 months were higher than the last 11-year 9-month average. Now, if you look at 2023, Clarksons are forecasting a growth of 2.2% against a fleet growth of only 0.5%. So again, it looks like 2023 should be a good year just on supply-demand statistics. If you look at the type of cargoes carried, you can see Capesizes were carrying 74% of the time iron ore, 19% of the time coal, and 7% of the time they were carrying bauxite. This is from their captive mines in Guinea, in West Africa, and through their own captive port in Guinea back to China. If you look at Panamaxes, 8% of the time on iron ore, 50% of the time on coal, 27% of the time on grain, and 15% on minor bulk. But if you look at Supras and handy sizes, you can see we are focusing most of the time on minor bulk, 57% of the time for Supramaxes and 64% of the time for handy sizes. Now, if you then look at the growth in minor bulk, and you can see clearly that for this year, the minor bulk growth has been forecast at 2.55% against that fleet growth for the geared sector, which is the sector that carries minor bulk, is forecast at 3.51%. So more or less in balance compared to the major bulks. And if you look at next year, 2.43% of growth and no growth at all forecast by Clarksons for the ships. Now, if you look at the first 9 months, what do you see? You see 21.18 million deadweight tons of ships have been added, or roughly 2.26% of the world fleet at the start of the year. And if you look at the internals of this, you can see that between the geared and the gearless, it's more or less evenly balanced. If you then look at what is the forward order book all the way to the end of 2025, it's less than 67 million deadweight tons, or less than 7% of the existing world fleet at the end of Q3. If you then see how this has been achieved, you can see in the first 9 months that we started the year at this number, ended the 9 month at this number. 23.09 million deadweight tons was predicted to be delivered. Actual deliveries were actually stronger, so there was a negative slippage of almost 6%. Now, for the balance part of this year, the fourth quarter, we've got projected deliveries of 9.17. Against that, we are predicting that there will be a slippage of 5%, and therefore only 8.71 million deadweight tons will be delivered. Against that, scrapping in the first 9 months was 3.29, million deadweight tons. We are predicting 1.71, and therefore you should come out at a grand total of 967.33 million deadweight tons at the end of the year, or a net growth rate of 3%. If you look at the past, and you will see that the forward order book at the start of 2009 was a gigantic 78%. But if you look at the forward order book position as of today, as of the end of the third quarter of 2022, it is less than 7%. And for the first time, you can see that the 20-year-old fleet is now higher than the forward order book. And this has not been there like that since the last 20 years. If you look at the same thing for Handysize and Supras, you get the same picture, except it's much more severe. Order book is very low, less than 4%. The existing 20-year-olds are at almost 14.5%, and like for like at 2025 would be 19%. So this fleet will shrink, but the cargoes carried by this fleet or the Handysize fleet will flow into the Supramax sector. And Supramax sector, again, you can see that the order book is at 8.8%. The 20-year-olds today are at almost 11%. And if you go to 2025 and compare 8.8 with the 2025 20-year-olds, it's all more than double. If you look at the port congestion numbers, Clarksons have changed the definition. They say now bulk carriers are only Capesizes and Panamaxes where port congestion is measured. It's not measured for the smaller sizes. But this is what it shows you. It shows you that for 2022, the first 9 months average is stronger than the first 9 months average in 2021. And so we see that congestion has actually increased rather than decreased. If you look at the average speeds, now this is for the 10-year average 2012 or 9-year average 2012 to 2020. This is for 2021. And then the orange one is for 2022 for the first 9 months. So you can see in the Capesize sector a big drop in the speeds in 2022. If you look at Panamaxes also, there is a fairly significant drop. When you come to the smaller sizes, the drop has been marginal, not that strong, but it's still there. So if you then look at what's happened in the speed area, in the 2003 to 2009 bull run, speeds were at 13.5 knots. In the 10 to 2011 year, when the markets were really low, the speeds dropped to 11.5. And after that, the speeds have not really recovered. Even though 2021 was a very good year and rates went up very sharply, speeds did not go up. And you can see in 2022, in the first 9 months, speeds have also remained lower than last year. So we think that this will help to slow down the arrival of or reduce the effective supply of ships. And then, of course, don't forget that for the first time in this century, the 20-year-old fleet is larger than the forward order book at the start of Q3, as being 8.01 versus 6.93. Now, why have new ship orders not gone ballistic even though rates have skyrocketed? And for that, there are three principal reasons. First is, of course, the container tankers, gas ships and car carriers have all ordered and booked up all the available slots. So bulk has been crowded out, and the earliest you can get a ship is in 2025 for bulk carriers. If you look at shipyard capacity, it's still 40% below the peak. Today, there are 119 active large shipyards in 2022 versus 320 in 2009. And this is according to Clarksons' latest data. Now, despite all of this, owners have not, and having a lot of cash in their books, owners have not ordered too many new ships. And the reason for that is the internal combustion fuel oil burning ships are going to become what are known as stranded assets. That is, their economic life will be shortened. And therefore, this is stopping people from ordering too many new ships. So why did the challenges in the 9 months of 2022 not sink the freight market? And the reason for that is that, okay, here are the challenges first. China's dismal import-export performance, I showed that to you on slide 2. Russia's Ukraine war reduced grain, coal, and other commodity shipments from the Black Sea. Central banks ended COVID stimulus, ended QE, and raised interest rates to combat inflation. US economy had 2 quarters of negative growth, but mercifully this has ended and third quarter was at a positive growth rate of 2.6%. The BDI averaged 2,066 points in the 9 months of 2022, down by 25% compared to the 9 months of 2021. So markets showed that they fell compared to the last 9 months of 2021. And low growth in ton-mile demand has been forecast by Clarksons for 2022 and for 2023. And Clarksons are forecasting a higher net supply side growth in 2022, but not in 2023. In 2023, they're forecasting lower than demand growth. So the challenges were there. What were they rescued by? The inefficiency of the dry bulk market, the very high price of bunkers slowing down ships, very low ordering of new ships, as I've shown you already, COVID lockdowns, quarantines, and congestion buildup. All this helped to reduce effective ship supply. Consumer resilience in USA and China kept demand growing. And we got this deal now where almost 10 million tons of Ukrainian grain has already been shipped between August 1st and end October. Consumers, corporates, governments are all wanting larger inventories. This is adding to demand growth. So what are the results of these challenges and the rescue? The result is that TC rates for index ships in Q3 and 9 month 22 compared to Q3 and 9 month 2021 was for Capes down by 68% in the third quarter, but overall down by 45% in the 9 months. Similarly, for Panamaxes, down by 49% in the quarter and down by 15% in the 9 months. But if you look at Supras and Handys, what do you see? You see we're down by 42% in the Q3, but down overall only by 4% in the 9 months. Handysize is down again by 42% in the Q3 and down by only 2% in the 9 months. So rates have shown that they've come down this year compared to 2021, but when compared to the last 11-year averages, they have been higher. And of course, China's stimulus has not yet taken effect and will kick in 2023 after the COVID lockdowns are lifted. So what are the industry takeaways? The good news is that in 2021, demand and supply balance was reached in mid-2021. China's stimulus plan of $667 billion on 22nd of May 2020 pushed the BDI to 5650, a 13-year high on the 7th of October from 1374 points at the start of 2021. Material improvement of rates started from second half 2022, but with extreme volatility. The BDI reacted positively to the strong world GDP in 2021. Time charter rates in the 9 months 22 are higher than the average for the last 11 years. New ship orders have been very constrained. The bad news is rates have declined after peaking on 7th October due to negative news from China and negative news from the rest of the world. So likely future, congestion increased in 9 months 22 to 33.8% compared to 32.7% in 2021, with healthy rates in 9 months 2022. Negative factors are responsible for the collapse in demand, but it's by government decree and not by demand falling. China's real estate crisis requires more time to resolve, and China's economic stimulus plan should get rates back above trend in 2023. So what are the catalysts to watch out for? So the things to watch out for is that, is the Ukraine's grain being shipped? We've already seen 10 million metric tons has already been shipped. Now, the unharvested grain in the fields will come out and come into the silos because the silos are full. Now they're losing the silos are getting empty with the shipments, and therefore they will move in. Cargoes from Russia and Ukraine in the Black Sea should get shipped, but this has not yet happened. China's coal consumption and power generation continues to rise. This has already happened. China's real estate sector recovers along. This has not yet happened. China does not have large-scale COVID-19 infections continue. So this is again a negative. Congestion at ports around the world increases. Congestion has decreased for the smaller sizes, but increased for the larger sizes. Iron ore from Brazil moves to China and other destinations, makes up the shortfall in the first half of 2022. This has not happened completely, but it's happening. And we see, at least in China, that it's almost coming up to, in the first 9 months, it's almost evened out. And the drop in iron ore has almost flattened out. Increase in interest rates in the rest of the world. Rate hikes are finally showing a slowdown. Canada is the first country to have reduced interest rate hikes. So what is our strategy in all of this? Of course, our strategy is to try to beat the benchmarks. And if you look at what we achieved in Q3, we were down by 11.5% compared to the index ship on our handy-size, but up 21% on the Supras Ultras. Now, keep in mind that our handy-size fleet is much smaller in size average than the index ship. And this is our forward order book. So the forward order, for the forward book on bookings of our charters for 2022, we have booked it at an average price of $21,500 for 5,045 days of the year, or 37% of all available days. Next year, we've already got bookings of $17,600 for 4,108 days, or 30% of our current fleet availability. And then it falls down to the 4 long-term chartered cement ships. And the fleet remains the same. We've added just 2 ships, so it's come up to 38. The average age is slowing down because we added some much younger ships than the average age on our fleet.
Okay, so moving on to financials. So the highlights of Q3 were, so our net income in baht came in at 1,348 million, or 0.86 baht per share. EBITDA came in at baht 1,696 million. We declared and paid a dividend number 2 of 50 satang on 12th of September. That was after the second quarter. In the second quarter, also on 25th of July, we took delivery of Pavida Nari, which is a handy-sized bulk carrier. This is vessel number 38 in our fleet. In October of 2022, 6 of our vessels were entered into long-term charter contracts at levels linked to the underlying index for vessels of that size. So some key figures in Q3 and Q2. Our revenue in Q3 came in at 68.8 million, down from 76.3 million in Q2. The net profit came in at 36.4 million, down from 48 million in Q2. Earnings per share in baht came in at 0.86 per share, down from 1.06 in Q2. The return on equity came in at 35.6%, down from 38.7%. Our net debt to equity ratio was quite stable at 0.35. As I said, we added 1 ship in Q3, so the number of ships went up from 37 to 38. So this graph over here on the top left shows you the average TC rate per day for our entire fleet. So starting from Q1 of 2020, you'll see the average was 8,398, and then you had the major COVID lockdowns around the world, and so it decreased. The average TC rate, time charter rate per ship per day for our fleet came in at 6,099, and then you saw a gradual increase as the world got out of the pandemic, the COVID pandemic. Things started to open up again, and it's been fairly stable. Of course, Q3 was slightly below Q2. Q3 came in at the average TC rate per ship per day for our fleet came in at 19,840 in Q3. This graph over here shows you the historical EBITDA for each quarter. So this more or less mirrors the trend in the TC rate per day that you see on this graph on the left. And so EBITDA for the quarter came in at 46 million, down from 57 million in Q2. Over here, we show you our dividends that we've been paying each quarter. So we've been paying a fairly steady dividend of 780 million. And then, of course, at the AGM, we had an additional 25 satang per share dividend. So that's reflected in the Q2 figure. And over here, we show you our average cash balance, or our total cash balance at the end of each quarterly period. This is our statement of financial position, so our balance sheet. So you'll see that at the end of the third quarter, the vessels and equipment figure has gone up to 640 million, reflecting the 2 additional ships that we acquired this year, this compared to the end of last year. Our shareholders' equity is up as a result of the profits From 430 million, it went up to 481 million. Our total loans, long-term liabilities, went down from 246 million to 207 million as we continue to repay our debt. And our cash was down slightly from 74 million at the end of last year to 39 million at the end of the third quarter. This graph over here shows you the cash movement between the end of the second quarter and the end of the third quarter. So at the end of the second quarter, we had 54 million of cash on our balance sheet. We generated 46 million of cash from operations. We spent 26 million towards the purchase of the vessel Pavida Nari. We made 3 million of interest payments, 10 million of debt repayments, and 22 million of in US dollars, 22 million of dividend payments, and that results in 39 million at the end of the third quarter. This graph over here shows you the breakdown of our operating costs in Q2 and Q3. This is so looking at the sort of the major components. You'll see that crew costs, some of the costs in Q2 came in much lower than the cost in Q3, and that's because in Q2 we received quite a sizable amount of proceeds from our insurance company. This was in relation to expenses incurred while the vessel Chayani Nari was detained in Nigeria. Just as a reminder, this vessel has been released. And we received about 1.4 million of insurance proceeds towards expenses that were incurred while the vessel was detained in Nigeria. And as a result, those were reflected in the second quarter operating expenses. So therefore, this came in at a lower level than expected. This came in at 4683. Now over here, it's slightly higher than expected. And part of the reason for that is because the crew members of the Chayani Nari who were previously on that ship, they continue to be in Nigeria, and we continue to cover all their expenses. We continue to pay them full salary. So I would expect until they remain in Nigeria, the operating expenses will be slightly elevated. So this graph over here shows you our operating expenses compared to the industry average operating expenses. You will note that we're always about $700, $800, $900 lower than the industry average. Now so every $100 in savings of operating expenses per ship per day translates to about $1 million on the bottom line. The figures for the industry average haven't been published for 2021 as yet. So over here we've compared our operating expenses and G&A to several of our listed peers in the industry, in the dry bulk industry, other operators, other owners of Supramax and Ultramax ships. We can't name them, of course, for obvious reasons. Now you'll see that, so first of all, from an operating expense standpoint, we are extremely competitive, but we're also very competitive from a G&A perspective. Yeah. And this helps us outperform them on an EBITDA per ship basis. Both, we don't have the figures for most of our peers for Q3, so we're looking at Q2. So you will see that we have outperformed our peers on our EBITDA per ship basis in Q2, as well as on a last 12-month basis. So we came in at 1.95 compared to all our other peers who were much lower. Same thing for the last 12-month figure. This over here shows you our debt maturity profile. So as you can see, it's fairly stable until 2026, after which it starts to decline. This over here shows you our net debt and net debt to equity ratio. So our debt peaked in 2017. We had a number of ships which we had taken delivery of in the prior years, and so therefore our debt was elevated. Of course, it's come down to, our net debt has come down to less than half of what it was in 2017, and the net debt to equity ratio is also down at a very healthy level. Okay, so this graph over here, so I show you the top line. The top line shows you the average age of our fleet. So you'll see that from 2000 to about 2011, The average age of our fleet was about 15. After that, we took delivery of a number of ships that we had ordered at various shipyards around the world, and the average age came down. It was at its lowest point in 2016. It was 5.8, and thereafter, we've not really taken delivery of any new buildings since 2017, and so therefore the average age has moved up. But it started to slow a bit this year because we bought 2 young ships from the second-hand market. The red line over here shows the average size of ships in our fleet. So again, so you'll see the average size was much smaller. We had much smaller ships in the past. The average size was about 22,000 back in the year 2000. And then we ordered ships which were much larger in the Supramax sector, in the Ultramax sector, as a result of which the average size went up to 44,000, and it's remained at more or less that level for quite a few years now, since 2016. The line below that shows you the average time charter rate that has been earned by our fleet since the year 2000. So from 2003 to 2009, we very much benefited from China joining the WTO. Thereafter, a number of ships that were on the order book, they were delivered, and this supply overhang caused a gradual decline in the average earnings of ships. Bottom was around 2015-16, and it's been going up since then because the supply side pressures have gone away largely. This graph over here shows you the dividends that we've been paying since 2003. Our policy is to pay not less than 25% of net profit as dividend. We've generally paid more than that, as you will see, on average. We stopped paying dividends in 2014, and we resumed paying them in 2021, 2014 to 2021. You will recall were extremely weak times for the dry bulk sector, and so we wanted to conserve cash. We didn't pay our dividends, but we restarted paying them now. So this is our financial highlights. I won't go into too much detail. I think I've gone through the overview. These are there as a reference. Same thing over here. Okay, so PSL and ESG. So again, so we've always tried hard to reduce our environmental impact by adopting new technologies. We replaced older and less fuel-efficient ships between 2013 and 2017. With eco ships that I said, so modern eco ships that we ordered, and this helped reduce the average CO2 per ton mile from 12.884 in 2014 to 7.42 in 2021. We voluntarily retrofitted our ships, many of our ships, with energy-saving devices like Mavis docks, pre-shrouded vanes. And this resulted in energy savings ranging from 3 to 5% on several of our ships. We've adopted a formal environmental policy statement since 2009 based on ISO 14001 standards, and this is upgraded to ISO 14001-2015 standards. We are a founding member of the Getting to Zero Coalition. This is an alliance of now more than 150 companies around the world in the maritime sector to explore commercially viable zero carbon emitting vessels. Last year we provided 60,000 free meals to needy residents in Bangkok over a period of 3 months from the 12th of August. We are a signatory to the Neptune Declaration covering seafarer well-being and crew change. We've been providing scholarships at the Merchant Marine Training Center of Thailand since 1995. So currently we provide about 42 scholarships each year. We provided a 1 million donation to the Michai Patana School in Buriram province earlier this year. We also, as part of our World Maritime Day celebration, many of our employees, we volunteered to clean up the Ban Ampur beach in Chonburi. Quite recently, we've been included in the THSI list. We've been classified as a company with excellent corporate governance for 13 consecutive years from 2010 to 2022. We've earned 100 full AGM assessment score points from 2018 to 2022. We're a member of Thailand's private sector collective action coalition against corruption since August 2019. And also we were the highest ranked global dry bulk shipping company in the S&P Corporate Sustainability Assessment rankings for 2021. So investor relation activities. So we continue to have a very busy calendar as far as investor relations are concerned. So this graph over here shows you the total return to shareholders from the time of our IPO in 1993 until 3rd of November. So if you were an investor in IPO in 1993 and you stuck with us throughout that period, you would have earned a 16.22% IRR on your investment. So some final food for thought. So we think that demand is expected to grow faster than supply, especially for minor bulks over the next couple of years. So that minor bulks are the cargoes that PSL carries. So we think these will grow faster than other cargoes. And also definitely the growth in those cargoes will be faster than the effective net supply growth in the geared sector. So geared sector, is the sector that we operate in. We're a Thai corporate, but we have zero business out of Thailand. So the weaker the Thai baht, the stronger our EPS in Thai baht, as all our income is in US dollar. So we are a Thai stock that's unconnected with the local economy. Part of our Bangkok expenses are in Thai baht, and that will reduce with the weaker Thai baht. We think the price to book value is not a good measure anymore, as asset values have gone up significantly since the start of the pandemic. And our debt continues to shrink. Our surplus cash continues to grow. And of course, this should be good news for our shareholders. With that, we are open for questions.
So there are a few questions already on the chat. So if I could just take the first one, could you please discuss current situation for handy-size vessels? Seems to have many open positions. I guess you're talking about the PSL fleet, and the reason for that is that clients in the handy-size sector are not able to give long-term contracts on the handy-size fleet. And if you look at the index ship for the handy-size sector is now at the 38,000 level, and our average size only works out to 31,000. Therefore, for us to get any form of long-term contracts, even if it's on an index-linked basis, would be very difficult to get on the handy-size sector, and that's why you have many more open positions. The next question is that the expectation was there that in the second half of 2022, the Chinese stimulus plan would come into play, and that has not happened. So the reasons, would that change if China were to relax their COVID policy? And the answer is yes. If China relaxes their COVID policy and allows industries to function in China, which they are not allowing to do during the period whenever there is a COVID outbreak, and there is right now a major COVID outbreak, by Chinese standards, not by world standards, not even by Bangkok standards, is a major outbreak right now in the province of Guangzhou, which is one of their large industrial hubs. So of course, this makes a huge difference in terms of cargo demand, in terms of raw materials or semi-finished goods in terms of exports. So this is something that we can do nothing about till they change that COVID zero policy. Then there's a last question. What are the reasons for good performance of Supramax, Ultramax versus Index in Q2? Can they be sustained? So yes, we think they can be sustained because more or less our entire fleet of Supras and Ultras are on variable rate contracts linked to the index. And therefore, we should be able to outperform the index, we think, during this period of time. Even though the numbers are falling, our numbers will be higher than the index numbers.
คำถามที่คีย์เข้ามามีเท่านี้ถ้าท่านใดมีคำถามเพิ่มเติมก็สามารถส่งเข้ามาในระบบได้เลยนะคะจะเป็นภาษาไทยหรือภาษาอังกฤษก็ยินดีค่ะเรายังมีเวลาอีกพอสมควรสำหรับวันนี้ค่ะเดี๋ยวรอคำถามที่จะเข้ามาเพิ่มเติมนะคะ
In the meantime, maybe I'll just take you through the three slides that we've not spoken about. These are the energy efficiency existing ship index, which comes into play on the 1st of January 2023. And you can see that the press reports indicate 70 to 90% of all dry bulk ships would be affected. The impact on us would be that 23 ships in our fleet would be outside the EEXI requirements. However, only 16 vessels will need to reduce speed to comply with the engine power limitation, and the speed reduction would vary between 1 knot to 2.5 knots on each ship, compared to the speed used in 2021. How much will it cost PSL? About $1 million, actually around $800,000. And we've given you the breakup of the costs on this slide. And what are the implications for the effective supply of ships? Every 1 knot speed reduction in the world fleet equates to 5.5% reduction in effective supply of ships if the ships sail for about 200 days in a year. If they sail for longer periods of time, it will be even stronger. If you look at the carbon intensity indicator, which also comes into play on the 1st of January 2023, this approach is with an annual increase or annual reduction in CO2. That means they want you to become more efficient every year compared to the best ship available in the world at the time. How many ships would be affected in the world? About 3,000 to 30,000 ships. Because ships below 20,000 deadweight tons are not affected. And how will we control the CI of our fleet? Gautam has shown you one of our slides on the ESG, on the environmental side, where we have shown you all the energy saving devices that we've already pre-fitted onto our ships. That will help us to control the CII of our fleet. And of course, we will optimize our operations and ensure our ships are in very good and clean condition. Now, here is an interesting slide that we got from thanks to Den Norske Veritas, which is the Norwegian classification society. So if you look at the start of this year, there were 960.33 million deadweight tons of ships. And they said that any ship above 10 years of age would be a ship that would have a problem in meeting CII. And therefore, according to them, 54% of 520.95 million deadweight tons would not be compliant with CII. And against that, if you look at the new buildings, is 66.59 million deadweight tons at the start of this year. And that was just 7% of the total world fleet at the start of this year. So 7% of new ships coming in will certainly be compliant, but then you've got 54% of the existing ships who will not be compliant as of the start of 2023. Now, if you look at the bottom half of this slide, we've shown you what DNV calculates as the end of 2026. What would be the number of ships or rather deadweight tons of ships that would be compliant and that or non-compliant? So compliant ships are A, B, and C. D and E are ships that are certainly not compliant and have to improve their record to come into the C level. From E, you must come to D, and from D, you must come to C. Now, if you look at the 2023 numbers, you can see that 46% in 2023 would be non-compliant, either D category or E category. But if you come to 2026, then this goes up to 62% by deadweight tons, which means that despite the new ships coming in, you still are having an increased deadweight tons of ships, almost 62%, which are not compliant, which means that right now, at least the law says that the law will not punish you. They just ask you to give a plan to improve. And they say that the market forces will decide. That means the clients will decide whether they want to take your ship or not take your ship. But if you look at it, even at the start of 2023, with something like 46% of non-compliant ships between D and E category, the clients have no choice. If 46% of ships are not compliant, the world will come to a grinding halt if people stop using them. So I think that you will find that ships will slow down their speed to comply, and this will reduce the effective supply as we go forward from 2023 to 2024 to 2025 and to 2026. And that is the only method left for them to reduce their carbon footprint and be in compliance with the CII. So I just wanted to share this one point with you.
ค่ะยังไม่มีคำถามเข้ามาเพิ่มเติมนะคะท่านไหนมีคำถามก็สามารถคีย์เข้ามาในระบบยังเหลือเวลาอีกสักนาที2 นาทีค่ะ One more.
Why do you expect Handymax and Ultramax to continue outperformance again? As we said, we have fixed these ships on index-linked charters. And if you have been following the release of information that we have been sending via the Stock Exchange of Thailand, you will notice that some of the ships have been fixed at a large premium over the index ship, and some have been fixed at a small discount to the index ship. Therefore, overall, we will certainly outperform the index ship.
ค่ะน่าจะได้เวลาพอสมควรก็คือสไลด์แล้วก็คำถามตรงนี้เราจะขึ้นให้ที่เว็บไซต์ของบริษัทเรานะคะงั้นก็ต้องขอบคุณทุกท่านที่เข้าร่วมพูดคุยสัมมนาผลประกอบการของ PSL ในวันนี้นะคะค่ะขอบคุณค่ะสวัสดีค่ะ